Modern consumers have developed a strange obsession with projecting their lifestyle and social status onto tiny pieces of metal and plastic. Over the last decade, an entire ecosystem of publications, tier lists, and influencers has sprung up to help everyday people navigate a growing maze of sign-up bonuses and category multipliers. People spend their free time researching their next application, convinced they are actively hacking the financial system to score free flights and cash back. But this chart showing the profit margins of major bank divisions tells a different story. While commercial loans, mortgages, and investment banking hover at moderate levels, the returns from credit cards absolutely dwarf them. Curious, slightly skeptical, if casual consumers are successfully extracting all these expensive travel perks, why is the money still flowing upward to banks in record amounts? The endless buffet of card options and payment networks is a carefully engineered illusion. Behind the gamification is a highly centralized power structure designed to keep the money flowing. Every time you tap or insert a card, the merchant takes a hit of about 2 to 3% of the transaction, known as the swipe fee. Most people assume that money goes straight into the pockets of Visa or Mastercard. This flowchart illustrates where the money actually ends up. The vast majority goes directly to the issuing bank as compensation for credit risk. Visa and Mastercard take a tiny slice as middlemen, shepherding the transfer of money from the cardholder to the merchant. These networks were not born as tech startups in Silicon Valley. They are products of the banking system itself, built directly by the big banks to handle the cumbersome physical paperwork of early credit transactions. They exist today in an unspoken harmony. Every CEO in the history of Visa and Mastercard has come from a big bank. The banks agree not to encroach on the payment networks, and in return, the networks act as the public whipping boy, absorbing all the political scrutiny. This tight-knit circle aggressively protects its territory. When buy now, pay later startups like Affirm and Afterpay tried to bypass this system, the big four banks reacted instantly, rolling out their own installment plans and banning cardholders from using credit cards to pay those competitors. Visa and Mastercard operate as a deliberate corporate shield. Their primary purpose is to protect an untouchable banking oligopoly from disruption and regulation. Leading up to 2008, banks relied heavily on the stick to generate revenue. They targeted subprime borrowers, changed due dates to confuse cardholders, and buried sudden interest rate hikes deep in the fine print. The Great Recession wiped out those profits. In response, the 2009 Card Act effectively outlawed this high-margin, predatory business model by mandating clear disclosures and setting strict rules on rate increases. Without the stick, the banks pivoted to the carrot. They began issuing dazzling new products promising tens of thousands of made-up, virtual points to incentivize perpetual spending without violating new federal regulations. This created the science of points arbitrage. Banks purchase loyalty miles in massive bulk at a steep discount from airlines and hotels, then dangle those points in front of consumers to drive up swipe volume. They apply the same logic to co-branded cards with retailers like Amazon or Kroger. These partnerships trap a brand's existing loyal customer base into a specific issuing bank's spending loop, generating instant cash bounties and revenue-sharing kickbacks for the store. These points carry no direct dollar value and represent zero book liability for the banks. They are an inflatable, entirely unregulated psychological lure designed specifically to mandate continuous consumer spending. Despite the billions generated by swipe fees and retail kickbacks, the true fortune lies elsewhere. The absolute largest transfer of wealth comes entirely from the interest charged when cardholders carry a balance month to month. This line graph comparing common lending rates illustrates the danger. While average mortgage and auto loan interest rates flatline near the bottom, credit card interest skyrockets exponentially above them, acting as unsecured microloans with radically high rates, completely detached from the Federal Reserve baseline. The banks are more than happy to pay for your airport lounges and first-class flights because the gamification works. It successfully conditions generations of Americans to take high-interest loans on everything from daily coffee to luxury vacations, encouraging them to spend far beyond their means. When politicians hold hearings to cap swipe fees or regulate the networks, they are missing the target. It is populist political theater that completely ignores the banks dictating the rules of the system from behind the curtain. Hoarding points and timing redemptions isn't beating the house. It is active participation in a behavioral trap, meticulously engineered by the Big Four banks to extract perpetual wealth from the working class.